Good afternoon, everyone. I'm Roger Miller, and I'm the Deputy Assistant Secretary for Healthcare. We're delighted to see you here, and we thank you all for joining us today, both here in the auditorium and, of course, out there on the web broadcast. This is the Office of Residential Health Facilities Stakeholder Forum on Document and Regulatory Improvements. And first of all, I'd like to tell you what we will be doing this afternoon. We'll be hearing remarks from Carol Galante, who is the acting FHA Commissioner, and also from Helen Konofsky, who is our General Counsel. John Hartung will be following up, and John, as many of you already know, is the Director of Policy and Risk Management for the Residential Healthcare Program. And he's going to be going over kind of a snapshot of the proposed rule and major document changes. Then that's going to be followed by an open forum, and Roger Lukoff, who is the Associate Deputy Assistant Secretary for Healthcare, will be moderating. And I'm going to ask Roger if he would introduce the panel to you all then. I thought that it also might be helpful to give you a little bit of background of how we got here. Continuous improvement is the hallmark of our office. The residential care program uses lean streamlining and continuously searches for the most efficient, smarter approaches to its entire array of operations. It does this based on input and assessments, one, from our own team, and two, from its many stakeholders. And that is where you come in today. We propose document and regulatory improvements based on the Section 232 program experience of both the residential care program and from multifamily. And of course, we've gotten input from folks in industry and also from the Inspector General. As you know, we had published these improvements about a month ago, and you probably have read them in the Federal Register. Now, what we want is a reality check from you all. We want your comments and your suggestions. There's a couple of microphones around that you can grab, and we can hear what you have to say. And for those folks out there in TB land, so to speak, you can send your questions to us via email. Before we get started, we'll hear from Carol Galante, and as I mentioned, she's the acting Assistant Secretary over Housing and FHA Commissioner here at HUD. Carol was originally appointed by President Barack Obama in March 2009 to lead the Office of Multifamily Housing Programs, where she oversaw the largest expansion in the history of the multifamily portfolio. Now, as acting FHA Commissioner, she has direct responsibility for oversight and administration of an entire portfolio, which includes multifamily, healthcare, and well over 20% of mortgages in the single-family national market. Prior to coming to Washington, Carol was a developer and owner and the president of Bridge Housing Corporation in San Francisco, California. Bridge is the largest nonprofit developer of affordable mixed income and mixed-use developments in California. Carol earned a Master of City Planning from UC Berkeley, is a licensed real estate broker, and has numerous awards in housing. Notably, she was named Executive of the Year by Multifamily Developer magazine. Carol, Thank you for joining us, and welcome.
Thank you, Roger, and thank you for the kind introduction. I think about the only thing Roger didn't say about me is that relevant to all of you is that I actually operated a continuing care facility and several assisted living facilities in my prior life. So I feel the pain and the excitement of doing these kinds of transactions. So anyway, thank you, Roger. It's a great pleasure to be here to welcome all of you lenders, attorneys, HUD staff, and other colleagues as we endeavor today to talk about the changes that are being proposed for the Office of Healthcare programs. I want to thank the HUD staff, the Office of Insured Healthcare staff that worked so hard to get us to this point, and I especially want to thank my colleagues at the Office of General Counsel for the great work and collaboration, again, in getting us to this point today. I had the pleasure of working on a similar project, as I know a number of you in the room also did when we went through this process for the multifamily programs not too long ago. And then I think you saw that we tried to be very open and collaborative with stakeholders and industry groups as we make some of these important changes to HUD programs, really modernizing them for the 21st century. So again, I want to thank Office of General Counsel and thank all of you for being here. We know that this healthcare program is vitally important to the country. The Office of Insured Healthcare is the only federal healthcare program that provides for the infrastructure needs of hospitals, assisted livings, nursing homes. It provides economic growth and jobs and very important policy priorities to be focused on. It's also important that we do this in a responsible way in terms of underwriting and risk management. It's our obligation to ensure that the efforts we put in preserve taxpayer dollars and ensure that we are appropriately taking care of risk in these insured programs. So that's the reason why we're here today, is that, you know, responsible underwriting and risk management really does require us to ensure we have appropriate due diligence and appropriate documentation of the work that goes into financing these facilities. So we also know that we have a great amount of work before us, and that is demonstrated by the fact that we have about doubled our production in the 232 program from 473 last year to over 750 commitments this year. And when you have a program that is at that, you know, moving at that kind of production and speed, again, it's important to ensure that we've got the right rules of the road in place. And so I'm very glad that we're here. I agree with Roger that we can all sit in the HUD building and think this stuff up, but we need your input and feedback to be sure that we've got it right. This is really the first time in 40 years that we are updating this particular set of documents. We know the world has changed, and we have to change with it and be sure that we all can comfortably move down the road in the 21st century here and be sure we've got a program that is really built to last for the future. So the proposed rules are published, and obviously very important to get your input. So thank you all for your time and attention here today. And I think with that, are you going to introduce Ms. Kanofsky?
Thank you very much, Gal.
Thank you.
And now we're going to say hi to Helen Kanofsky. Helen has been with us now since 2000, I guess a little bit before 2009. And yeah, same day.
We've been
Yeah.
You've been
at
for
it.
a long time.
Yeah, you have been. Good. She's been our general counsel, and since she's our general counsel, she is our chief law officer and principal legal office advisor to the secretary and to the staff of HUD. Helen is also the head of the Departmental Enforcement Center. In all, Helen, her office of general counsel has over 600 employees just in headquarters and in regional and field offices. Prior to coming to HUD, Helen served as chief operating officer and general counsel of the AFL-CIO Housing Investment Trust, which is a $3.5 billion registered investment company. Helen owns an A.B. cum laude degree in government from Cornell University, where she was Phi Beta Kappa, and she received her J.D. cum laude from Harvard Law School in 1976. Thanks for joining us, Helen. Pleased to have you with us.
Well, thank you, Roger, and thank you, Carol. It's probably worth saying, as Carol noted, that she was an owner. When I was at the AFL-CIO Housing Investment Trust, we were an investor in 232, so I brought that experience with me here, as well as spending the last 3 years dealing with issues surrounding this program, as well as multifamily and a whole variety of other issues, as Roger mentioned. I think everybody here knows that on May 3rd, we published the rule and transitional documents and an accompanying 60-day notice, and that marks a great milestone in the development of the 232 program. As set forth in the Federal Register, we now look to you, our stakeholders and the public, to provide comments on these efforts, and that's the reason we're here today. The Federal Register sets forth a formal comment process, and the period for public comment remains open until July 2nd, and after that you can take a vacation for the 4th of July weekend, or the middle of the weekend into the weekend. After the comment period closes, we here will be reviewing all of the comments received, and we will be adjusting the rule and the documents as appropriate. We'll then publish the final rule and the final documents, and they will go into effect approximately 30 days after publication. We urge you to submit written comments according to the process set forth in the Federal Register, but we welcome this opportunity to hear your comments in person. Because we're in the middle of the comment period, members of OHP are here taking notes to have a general summary of the key issues and the comments, and we'll add that summary to the official log of comments in regulations.gov. We may ask you to pause or rephrase your comments to be sure that we are accurately capturing the key points made. We're also recording today's forum and will make it available on HUD's website. We look forward to discussing your comments with you, but since we are in the middle of a comment period, there's some limits to the extent to which we can respond. We will not elaborate on the rationale behind the revisions we've proposed in the rule beyond the explanations already given in the preamble. The preamble is our public statement of the reasons we proposed the changes that we did. However, we encourage you to share your comments and the rationale behind your comments. So often during the rulemaking process, we receive comments out of context without any information as to why our stakeholders are making a particular suggestion. This forum provides an opportunity for you to let us know not only how the rule and documents affect the industry, but why they have the impact that you think they will have and what it is we ought to be considering. Please also keep in mind this forum is not the appropriate venue to wordsmith the proposed documents. For that, we encourage you to submit written comments through the procedure set forth in the Federal Register notice. We take your comments very seriously. We may not always agree with you, and we may not always be able to implement your suggestions, but we do listen, and that's part of what we're going to be spending this afternoon doing. So thank you again for attending. Thank you for the comments you will give us today and those that you submit in the Federal Register. And we hope you, as we think most of those who worked with us on the multifamily document revisions, will be happy with the end result and will find that they make all of your lives easier.
Thank you very much, Helen Kanofsky. I've known Helen even before she arrived, and it's always good to see you back here again.
Good.
And I'm sorry that I stumbled over your name. The next person, as I mentioned, would be John, and John is going to come up and give us kind of a thumbnail sketch of what we've had the opportunity to review. John?
Thank you, Roger. And we will get to your comments in just a minute. The main reason we're here, I'm just going to take a moment and go through some key aspects as we see it. Of course, the scope of the publications are very broad. We've got 150 plus documents covering all aspects of our operation, and a proposed rule that it limits REAC inspections on skilled nursing facilities, as you know, and it provides the regulatory basis for many of the things in the documents, many of the aspects, including clarification and enhancement of the operator responsibilities. That's from a financial, from an operational and an accountability standpoint, and the creation of the long-term debt service reserve. Looking at particular documents, and we'll just touch on a few. The operator regulatory agreement. This has very substantial changes. We hope improvements to that agreement. We're requiring quarterly and year-to-date financial statements. There'll be a spreadsheet submission, not online via REAC. It's certified but not audited. We're requiring the operators to maintain positive working capital, and we look forward to your comments on that. We're requiring prompt notice to HUD and the lender of matters that put the permits and approvals at risk, so that we can take action. And we really lay out a strong basis for taking prompt action against the operator where needed. I'm going to continue with the moment without being able to forward that. But the next document is the owner regulatory agreement. And that dovetails with the operator regulatory agreement, the changes we've made there, and that's also where we place the long-term debt service reserve provision, which is, of course, is a substantial change. And we also discussed surplus cash in that document. We of course require that distributions not be taken when the regulatory agreement is not being complied with and so on, but we changed the historic approach that we've had to that, and simply require a semi-annual reconciliation, if you will, with regard to surplus cash. The management certification, many of you will recall that on most deals, if you will, we don't have a management cert, and there are some where we've needed one but not had one, and there are some where we've taken the multifamily management cert and tried to mark it up, if you will, to fit the 232 program, and it doesn't. And so we have a new management cert that really gives us a controlling document with that management agent, and really enumerates the whole range of responsibilities that a management agent would be expected to comply with. Now, the master lease addendum, many of you have probably had a chance to read through that, and we look forward to your comments. We've had master leases for quite some time, for a number of years, but not a standard addendum, and this represents a lot of input from a lot of you, we'll look forward to further improvements. But of course, it emphasizes one indivisible lease of the facilities, not separate leases governed by similar terms, and provides the cross-collateralization of the subleases, and it gives the lender substantial rights, but with very substantial cure opportunities on the part of the operator. The operator security agreement, you'll want to look, we'll welcome your comments on that. The Exhibit B to that really lays out the scope of everything that's covered under that, and it is very broad. And then finally, the security instrument mortgage deed of trust, that makes various improvements along the lines of what multifamily made in its recent document revision. So that's it. I think we're ready to get into a discussion. We do, again, encourage you to put your comments in writing, submit them online or otherwise, as you have a chance to further consider this. But we look forward to hearing from you today. And I believe Roger Lukoff is going to moderate and facilitate this, and so welcome, Roger.
Thank you, John, and I invite the panelists up front as well so we can get started. In addition, if you want to line up behind the microphones, we'll take people in order. In addition to John Hartung, up here at the table, we have Camille Acevedo. Camille is our Associate General Counsel in the Office of Legislation and Regulation and has been a tremendous advisor in this process. Kathy Soroka. Kathy also has played a tremendous role with us in this process. She's the Special Assistant to the General Counsel. And we have Debbie Brain, who's also been heavily involved, and she is a senior attorney for insured housing. So unless anybody has any other opening comments, we will entertain any suggestions, comments. Can begin now.
I mean, I've got a list, so I might come back a little later.
Great. Steve, even though I know you, if you could just state your name and organization.
I'm Steve Irvin with Berkadia. There's a list of, we've just begun getting through these documents. As you said, 154 documents, 60 days hardly seems like a long enough period of time in order to review them. However, we will do our best. Very simply, there are a couple of things that I think are lacking in the discussion or in the review or the creation of these documents. One of the concepts is that lien has been in place now for several years and has dramatically improved the operations of the Office of Residential Care Facilities and specifically the 232 program. Part of the main benefit of the lien program is that it is in fact flexible. It moves. It is allowed to adapt, and all of the changes that we have seen over the last 3 years have been adaptations that have improved this program. By placing some of these burdens within a rule or a regulation, we take away the very benefits that the lien program grants us and eliminate the ability for us to make changes. In addition, some of these regulations and rules are more appropriately addressed with something that says in the event of default, then we will require you to prove working capital for an operator, for example. These items are lengthy, and there are many items that are issues, but there are some that are specifically that will specifically stop good operators from coming into the program. One example would be segregated assets into an operator's account, into an individual operator's account. That is not only contrary to the way that the industry operates, it is specifically contrary to current accounts receivable financing guidance as published by HUD and accounts receivable financing guidance as published within this new rule. So there are a lot more. I'm going to let other people get up and speak. I will get up again if everything isn't covered.
Thank you.
My name is Chuck Bissinger, and I'm not bashful. One of the things that I think that there are 3 or 4 categories as I look at it of issues that I see, primarily from a lender's counsel point of view and seeing how borrowers are likely to react. And I think there's the whole issue of the long-term debt service reserve. There's the issue of really significant increases in the regulation of the operators, some of which I think are well thought of, and some of them are probably not. And then there's issues relating to accounts receivable financing. And at least on my trip to the microphone this time, I'll talk about the debt service escrow. We've seen debt service reserve escrows on many projects on a case-by-case basis that's come as part of the underwriting of the individual transactions as a special condition. certainly some more uniformity in what's required in the circumstances is a good thing. But requiring it on all projects for the life of the loan sort of seems like, hitting a fly with an atomic bomb. A few things that I think are reasonably easy to understand and deal with on it. First of all, I think it would be inappropriate to require the debt service reserve in connection with the 223A7 transaction where the project does not already have a debt service reserve associated with it, or to increase the requirements with respect to the debt service reserve in those situations. Absent unusual circumstances, I can certainly see an A7 that was done as sort of a workout mitigant situation where you might impose a debt service reserve. But in general, your run-of-the-mill 223A7 to impose a debt service reserve, is making it more difficult to minimize HUD's risk. And of course, we know that with the 223A7, you can only borrow back up to the original loan amount. So that would be, I think, something that should be thought long and hard about. Second, in terms of the funding of the debt service reserve, I didn't really study it and I didn't really understand it other than to know that it was sort of, not right. The cost-benefit analysis of the debt service reserve, when the debt service reserve is funded with equity, those equity dollars are very expensive, and it's a problem. I know that as part of the rule, it's proposed that HUD would allow the debt service reserve debt service reserve to be included as a mortgageable cost in the 223F program, which has not historically been the case. As I mentioned before, that doesn't help at all with an A7 where you're going to be limited by the amount of the loan you're refinancing. But I do think it makes sense, assuming this requirement goes forth, to allow for the debt service reserve to take the mortgage amount above HUD's self-imposed 80% loan to value. So if you have a project which otherwise would be an 80% loan to value, and there's a debt service reserve equal to, say 2.5% or 3% of the loan amount, that you would allow the loan to value to go back up to 82.5%, whatever the number might be, obviously not exceeding the 85% historical limit. Allowing the loan to be the debt service reserve to be funded in that way, essentially through loan proceeds, seems to meet the goal of providing what I assume is the goal of providing a sort of ready source of liquidity in the event of a problem, without imposing as much of a burden on an owner. Also, allowing the debt service reserve to be funded by a letter of credit rather than cash as an option with the lender and the borrower would be helpful, and I think would still meet HUD's goal there. Another point on this is the fact that this is being required in all cases for the life of the loan. If you've got a loan which is a 50% loan to value and a 6 debt service coverage ratio, doesn't seem like a good case for a debt service reserve. I suppose that the rule allows for flexibility in setting the amount of the debt service reserve. Not clear what kind of guidance HUD will ultimately issue on how you determine the amount of the debt service reserve, but it seems that projects that represent a lower risk to HUD should enjoy a much lesser or no requirement for a debt service reserve. Also, over a period of 35 years, typically, things change, and it would seem that if a project has a demonstrated history of strong performance, that a release of that reserve, could be appropriate. Finally, on this subject, explaining to a borrower why they have to set aside this amount of money in a reserve and sort of pay interest on it is tough, but not letting them get the benefit of the interest earnings on the reserve and requiring that to be part of the reserve seems unnecessary and unfair, and also essentially allowing the funds in the reserve to be accessed only in HUD's sole discretion seems to make it harder to explain to the borrower the purpose of the reserve or why it's to their benefit to have it. I can certainly see, and having been involved in conversations with borrowers who are clients, but typically with the lender talking with the borrower and their attorney, you know, the argument that, well, you know, if the project gets in trouble, this money is going to be there for you to draw upon, like an operating deficit escrow in the traditional fashion. It helps to mitigate the issue from the borrower's point of view. But the response is going to be, well, I mean, if I get in trouble, I mean, you know, HUD may or may not let me draw on those funds, and who knows what kind of conditions they're going to impose. So I think it makes sense, if you're going to require the debt service reserve, you know, to meet debt service at a point in time when the project is struggling, that there ought to be a clear right to access the funds in that circumstance. Thank you.
Thank you. Anybody at the table want to comment?
I think, you know, I would just say that we'll take all those comments under advisement, and specifically, we are looking exactly that kind of feedback, particularly the rationale as to, you know, why you would think that it's that in all cases, requiring it in all cases would be a heavy burden. I think it's interesting to see the perspective of the different scenarios where it may or may not apply. So we'll certainly take all that information into account. Would you agree, John?
Yes, thank you.
Hi, everybody. My name is Patrick Coffey. I'm from Capital One, and we provide a lot of AR financing in this area, and have done so in my previous stops as well, and spent a lot of time actually involved with the folks here drafting the original kind of intercreditor and rider and the like. And you know, first, what I want to say is that, you know, obviously it's a business that we are very, very fond of. You know, we've enjoyed providing capital in that space. However, I think there was a number of changes that were made that were actually discussed when the original one was drafted, and for a number of different reasons, those were not put in there. I mean, I think, you know, simply, yeah, like Steve, I have a list of different items, and what I'd really want to do is kind of have a breakout session and kind of go through that, because I think that actually our interests are more aligned than maybe people think. You know, there's a lot of value in having the AR lender there, and a lot of the kind of early looks that we get. And a number of the provisions that were changed in that intercreditor and rider would actually, I know for us, would force us out of the business, because there are things that would just make it untenable for us. And I know that, you know, I've discussed it with a lot of the other folks that provide AR financing in the sector, and I think the answer is kind of universal across that, and that's clearly not what we want. And I think, I don't think it's actually what you want either. And I think a number of us sat down, and what we'd really like to do is kind of have a collective group, you know, some of us, some people from HUD, and kind of get together and discuss that, because I think there's probably a lot of commonality, and I think it would behoove us all to probably get there. Thank you.
Well, I mean, we'd like you to say as much as you can here in terms of the specificity.
Okay.
I know that you will certainly anticipate
Everybody
that you'll
sit down
follow
and get
it up.
comfortable.
Yeah. Camille, do you just want to talk about that?
The first one is basically the cutoff time, right? You know, in the existing document, there's a 30-day cutoff time, and now it's an immediate. Basically, do you want me to get into the reasoning of why I don't think that works? Okay. The reasoning why I don't think that works is what that means. Number one is I'm not going to provide capital, right? Because I'm not going to be able to adjust quickly enough, right? If you immediately flip off my lien, that I have no protection for myself, right? And the reason I don't think you want that to happen is because I'm the one who's collecting the cash and I'm providing capital. If you flip my lien, the first thing I'm going to do is stop providing capital. So if I'm not providing capital and there's payroll that has to be met, there's dietary needs that have to be met, now somebody else is going to have to provide that capital, right? If it's a cooperative process, I'm going to continue to provide capital, right, under certain restrictions, right? But if my lien is cut off, I'm immediately not providing capital, obviously, right? And so that's a perfect example of one where it would drive me out of the business, and two, I actually don't think that that's actually in your interest either, because that means potentially you have to write a check, because I'm not going to write the check if my lien's cut off, right? And for me, you know, I have money out the door. The worst thing that can happen to me, and I think the worst thing that can happen to the HUD lender, is that payroll is missed, dietary is missed, because now the value of that building just plummeted, right? For me, if it's not an operating business, it becomes harder for me to collect out on the money that I have out on the door, right? So, I mean, I think it's kind of mutually assured destruction is really what it amounts to. And I think, again, that's a perfect example of how the interests coincide and how I think the change would create a big problem. Let's see, number 2. The 2 and 3 they both deal with the shrinking of the lien. The first thing that happens is if there's a default, then all of a sudden what actually my lien protects is now severely restricted. Again, it's very similar to the first point, that now if you're going to restrict my lien, the first thing I'm going to do is stop funding, which is the worst thing that can happen for the HUD lender, because then payroll gets missed, dietary gets missed, those types of things. Now the value of that business, right? I mean, we all know what happens if you don't pay payroll, right? The value of the business just plummeted because the business just shut, right? And in particular here, you have all kinds of life safety issues, all those kinds of stuff. You can't just not have capital coming into the business. And I think this gets, now I'm talking about this, it gets into a much bigger issue as to why, why do you want AR lending in the first place, right? I mean, as we all know in the skilled nursing industry, you're providing services now. I'm going to get paid 30 days, 60 days, but my bills are due now because I have nurses, I have food, I have therapy, all those kinds of things, which have to be paid now, but I'm not going to get my reimbursement for 30 days, 60 days, whatever the case may be, and that's the role that we as AR lenders fill. We want to keep going? Sure. The next one is the general lien was narrowed, right? Currently, the way that it works now is the lien on the operating company is FF&E and all the kind of related assets. What it says now is that it's AR and identifiable cash proceeds. Well, there's a number of reasons why that doesn't work, right? I mean, AR is an intangible, cash is fungible. If you have cash accounts, if you have investment accounts, things like that, right? It's way too narrow, and again makes it so that once the AR is turned into cash, right? I still need to be protected by that, and if I immediately lose my lien in that, then it becomes an untenable situation for me. The next thing, the idea of AR loan obligations. So now there's an attempt to define what actually my lien secures, right? Which again, it's all the same type of thing. If I'm getting into cutting hairs over what I need to be much more careful, right? And if I can provide capital, the amount of capital I'm about to provide is going down, right? Because now you've restricted what my pool is, what my avenues to react if something doesn't go right, things like that. You've kind of put me into a box and made me unable to react to any type of situation, which again, it's all going to come back to the common theme, which I don't think is in either of our interests, right? Because Sure.
Can you clarify that point? Are you saying that any definition of your AR obligations is too restrictive, or are you saying that the current definition is too restrictive?
I'm saying that the definition in the current draft as proposed is too restrictive.
And in your written comments, do you plan to articulate
Yes,
an alternative?
Absolutely. I have about another 10 or 15 items. They're more of the minor issues, but a lot of them are going to come back to the same theme. And again, my overarching goal would be to try and sit down with some select group of people and try to work through some of these, because I think actually the interests are aligned in a lot of ways. But we will put all of that into a written.
Yeah.
We're just discussing as to legally whether or not we can do something like that. But because the AR financing documents aren't part of the proposed rule, we may have some more flexibility. So we'll take that into your request into consideration.
Just to give you an idea of what was done last time, there was a lot of kind of like working discussions. I was not at Capital One at the time. I was at Capital Source. We put together basically training materials about what is AR lending? Why is it important? How does it work? How do the lock boxes work? All that kind of stuff. And literally, that was a process that took place over years. Like literally from until the intercreditor was done, it was about a 6-year process. And we'd be happy to do that with whoever the correct people are, whoever the correct people from our side of the industry. We welcome that opportunity, I guess is the right way to say it.
Thank you. Thank you very much.
I got about 11 things on my list. Brian Reynolds from Capital Funding Group. I have 11 things. I'm going to do 3, and 2 of them are expanding on what Steve and Chuck had to say. And first, I want to talk about the permanent debt service reserve. Chuck pretty much hit everything. I don't think he talked about TPAs. I don't know why we would need to do debt service reserves on TPAs. They're already within the portfolio, and if the assumer is going to be creditworthy, there's no reason to do a debt service reserve. Also wanted to talk a little bit about what size of debt service reserve, because it's really left wide open. And I want everybody to realize we're sub 3 today, so the industry can probably take this. But if we were at 8%, and you're talking about a 6-month interest reserve, that's 5% of your loan. Okay, so everybody should understand what we're talking about here. And if you're talking about 3 times coverage like we have today, on most loans, interest reserves are probably not needed. I think that HUD is already using them in the manner they should be when you have a deal that's probably not where it needs to be. And then you may want some kind of interest reserve. And in this case, in all the ones we've done, they've been released after stabilization. So, we don't feel that are necessary unless for some specific reason for that project. I wanted something new to talk about, I haven't talked about yet, is single asset entities for operators. I think that's more and more industry standard, so I don't have a problem with that in general. But there are existing operators that don't function in that manner. And to force them to chow or change operators in order to do a HUD loan is probably not reasonable. So I would suggest that you could require single asset operators on construction loans or if it's acquisition financing. But for general refis, you shouldn't require it. Steve talked about segregating project assets, and that's really probably a non-starter for most of my clients because it flies in the face of all cash management and greatly increases their costs, especially when some clients are paying $1,500 a year for a DACA. And to ask someone to have 20 DACAs if they have 20 projects is unreasonable expense, especially when HUD gets nothing from it.
Thank you.
If I may, with regard to the debt service reserve, in the proposed rule and so on, even in the I believe in the agreement itself, in the regulatory agreement itself, we talk about the debt service reserve and kind of the rationale for it, and we talk just language we've already have in there about it being a long-term service reserve because it is often well into years of a project where it's in trouble, and we talk in there about the possible the benefit that we've seen in instances of having a number of extra months to work through a project, to do a workout when a project is in trouble, and so we talk about that in the proposed rule. And in your written comments, when you submit, you might want to speak to that and speak to any suggestions you have on those lines. If what to the extent that what we have proposed isn't the way to go. If you'll speak to that concern, the fact that this is a long-term reserve, because we're looking at the life of the loan, not just while the project is, in its incipiency, whether it's a new construction or a refi. Thanks.
Good afternoon, Rod Owens of Kruth and Altman. One of the things that seems to be missing here is the handbook, and to have regs and loan documents and a handbook that aren't always in sync could create some problems. And then also, as Steve pointed out, the flexibility that the lien program has afforded is what's made it very successful and brought in a great class of borrowers. And so it seems that what we really need to do is have all 3 of these things worked on together at the same time. So one thing I would ask you to consider is, before you implement final loan documents or regulations, publish the proposed handbook, also republish these documents and the regulations so that we can comment and work on them all together, because there are plenty of things that are legitimate concerns that you all are addressing in either the regs or the loan documents, but they may be more appropriate or better handled as a handbook. And so if we have all three things published at the same time, we can work and discuss them, as one unit and make sure they're all, all consistent. So I would ask before these things get finally published that we do that effort if we can. And then the other thing I would make a point is, one thing when we're evaluating how we want to change the program or new requirements is we've got to really understand the type of borrowers and operators that you guys want to come into the program, so that we can know that are the things that are being proposed going to encourage them or discourage them. And the debt service reserve fund is clearly a big one, and some of the restrictions on the operators. So one of the things I think you all could help share with us is, where do we want to take the program so that we know, all the lenders out here know where they should be going to for new businesses and who they should be soliciting to come into the FHA program, so that we can tell you this is going to keep these guys out, or it'll encourage these guys to come in. And I think knowing where we're going to go down the line is really what should be the overall focus in evaluating each of these provisions.
Our understanding was that some of the provisions that would go in the handbook do require regulatory change first. And we can certainly speak to council about that, but that there's some sequence that needed to be followed. Whereas a rule is put out for comment at the proposed stage, the handbook is not, and so on. So we appreciate that observation. We could talk with council about that. So okay, thanks.
Ed Williams, Regions Bank. I pretty much have the same comments that everyone else has. There's been a lot of flexibility with the lien program that has added new, more sophisticated borrowers into the program. A lot of these proposed changes will definitely force people to look in a different direction. Also, I don't believe that we've allowed sufficient time for the changes that we've implemented over the last 2 years to really take effect. I mean, we've instituted risk management. We're requiring master leases even down to 3 properties. We have an imposed LTV at 80%, and we're doing 75 on new construction, requiring the borrower to have, roughly 30% cash in transactions. So we have some belts and suspenders that have been put in place over the last few years, and I just don't believe that we've allowed them to really sort of take effect. And then also, as Brian pointed out, interest rates are very low now, borrowing costs are low, but what happens when interest rates are 7 and 8%? That takes a huge chunk of the loan amount, requiring a debt service reserve without changing the loan-to-value restriction. And quite frankly, that money could go somewhere else. I mean, it could go to putting that money into a property, improving, giving it a facelift. I mean, that could be $500,000 easily. So these are just some of the things that, in polling some of our originators and bankers on the ground and talking to their clients, these are some of the things that are causing concern.
Ed, could you elaborate or clarify your suggestion with regard to the point that we haven't, there hasn't been enough time to see how some of these changes are working? And therefore what? And
So therefore, why the changes now?
Okay.
Is really what the question is. You've started to, on certain deals that are underperforming, you require debt service reserves as a special condition, and those debt service reserves get released at some period in time once the property restabilizes, not for the life of the loan. The life of the loan is very excessive.
Okay. Thanks.
My name is Dominic Romeo. I'm with the operating side. I'm not a lender and a lawyer, but I do have a whole bunch of properties that I'm fortunate to have closed with you all. I appreciate that. I got a good bit of information. I do do some business with several of the folks in the room. I just had a couple of comments I thought you'd like to hear them. In terms of one of the things that was talked about is to assure that there's positive working capital every year. If you kind of think through that a little bit, you know, this business, the nursing home business, still, you know, despite efforts, you know, to increase private pay utilization, even Medicare utilization, still is, you know, largely dependent on Medicaid, from 50 to 75 or 80%. Medicaid still, in most states, has an underlying cost basis to it. To the extent to which you take over a problem facility and it has a challenged rate, and you're going to, you know, increase staffing patterns, and you're going to continue over a period of years to stabilize that facility, to change its reputation, by definition, you're going to be challenged to meet working capital in terms of a positive output every year. Secondly, you know, by definition, the whole AR program, if we find that that's beneficial, and I think I've got all the little tricks and traps. I've got an insurance waiver, and I've got a AR financing that's approved by you all. The working capital line, if I had positive working capital every year, I would never really go into that AR financing. So you're sort of, you know, mitigating that one financing scheme that is real beneficial. Any capitally intense business needs to be able to access the working capital markets, and that's the mechanism that we have here. In terms of cash management, probably the thing that I'm perhaps the most passionate about, that really motivated me to fly up here and get my nerve up and talk to you all, is the idea of segregating the cash. The proposal that, you know, you're talking about here sort of contradicted what I heard early on in the remarks, where we want to take things to, you know, the more modern way, more modern era. The individual accounts, isolating deposits, you know, presumably isolating everything from AP down to payroll, is really more going back in time. That was the structure that occurred in the 50s. I'm the, you know, fiscally responsible for an entity that has about 80 nursing homes. We have a number of other ancillary service operations. We have a lot of bank accounts. You know, I have a very sophisticated treasury system, PeopleSoft, that integrates directly with the bank. You know, we sweep money up, down, over, you know, adding to these, adding that second AR facility that's sort of isolated from the first one was costly. You know, honestly, I don't know if I'd go back and do it again. To add, you know, an additional account for every HUD loan that I would have had or would have done, the doc is, as was pointed out, very expensive. Banks don't like them. The transactional fees on each one of those accounts are pretty significant. And I don't think you gain any benefit from it. I mean, what effectively that would do is rely on the banking system rather than a general ledger. And I'm an accountant at heart. The general ledger is really, you know, the thing that you and I want to make sure is right. Some of the talk about the management agent, I'm sorry, I don't probably have as good of an understanding of that, but little pieces that I picked out of there is, I would hope that you would identify those that are, you know, sort of like my company, where we own what we operate, rather than where you have a difference between the owner and the operator. You know, I saw a lot of things in there about subject to approval. There's a lot of interpretation that occurs, I think you all know, within your organization. So I'd really rather be in a position to where I'm not forced to be asking for, you know, an approval or a waiver again because of this. You know, the sort of things that scared me were the, you know, can I pay my boss? You know, he owns the company. Those type of things. If we're in compliance, we're in compliance. We'd like to just continue to do business. And that kind of goes into the debt service reserve. What is common in the industry now, and I mean in the industry, not in HUD lending, in normal, you know, not normal, but in transactions that occur with banks that don't have a government backing to them, there's typically a waterfall that occurs. If you have a problem, if you have a condition of default, then a series of things begins to happen. And the bank in those instances isn't really interested in, you know, foreclosing on the loan. I don't think you have that interest either. So one of the first things is, you know, and the waterfall may be, you know, you post a debt service reserve of X amount, or you have to post collateral to correct a fraction in some loan covenant. And I think if you kind of look at some of the things that you're suggesting here, and you step back and you were to make those as an if-then rather than on every new loan, you might get what you really want without compromising the integrity of what you have right now. Thanks.
Can I just ask you to clarify, just elaborate a little bit on your comments on the segregated accounts? I know that that's a common theme. God bless me, I'm a lawyer, not an accountant, and Roger has tried to explain to me the accounting, but I would really appreciate a little bit more elaboration on the accounting aspect and the way that you see it working best with the accounts not segregated.
What's common is to have a government and a private depository account. And the government depository account receives electronic funds transfers from Medicaid, Medicare, really any payer goes into there. And that has, deposit account control agreement. Funds flow from that account into a private depository account. And the reason for that is the lenders, the AR lenders, can't perfect their interest on that government depository account just by nature of who's making the deposits. As I understand the proposal, it would be that where I'd have to have a government depository account and then by default probably a private depository account for each and every loan. Well, if you got 2, maybe that's not overwhelming. I've got 30, and nothing, frankly, from where I stand, is accomplished by that. You don't gain anything in terms of control that you don't have already between the master lease, the loan documents, et cetera. In fact, I would argue as an accountant, you erode internal control by adding all of these layers of accounts and transactions that are occurring just to accomplish the same thing that I've got now with really one account. My primary account that is not related to HUD, by the way, I have 374 some odd EFTs targeting one single government depository account. Now we have home health, we have hospice, we have pharmacy, we have source programs. But all of those consolidate into a single account. It's highly efficient. It integrates directly into our general ledger, and it's provides probably what I would expect to say is the best measure of internal control that I could put into place.
So does that, currently your accounts are, you say you have one government accountable.
I have my cash system bifurcated, all my HUD facilities, and I have
your non-HUD facilities.
And there's transactions between them. Is a practical matter. You can never completely bifurcate anything if you're running one big business. There's invoices that are paid by the side of the firm that is non-HUD financed that relate to these, and so there's always transaction activity. That's all evidenced in the general ledger, and that's really sort of key to my point. Is the general ledger is really the document and the internal control that you seek. The bank account doesn't afford you that by nature of it just being a bank account.
Mm-hmm. And do you have single asset entities operating all of your facilities that are flowing into the same accounts?
We do for those that we have transacted with HUD. That's not an overwhelming issue.
Mm-hmm. And that doesn't affect the accounting.
No. The PropCo, what you basically go about doing is at the point at which you're moving towards a HUD loan, you strip out anything that's within a PropCo that doesn't relate to the entity that you're trying to take to HUD. So sometimes there's like an additional parcel of land. I mean, that's really all it comes down to.
So, I mean, we've got several related issues. We've got the segregation of the segregated account issues, the separate accounts, and then also the working capital requirement. We would welcome suggestions on addressing working capital concerns. Assuming you don't have segregated accounts, but what would be your position on the working capital requirement, though? Assuming that the separate account issue is worked out, the working capital, we welcome comments on that aspect.
I'm not entirely sure. I know maybe catch me after, but I don't follow you.
Okay, okay. All right, well, in general, you know, as folks are commenting, you know, we want to, the objectives of our work, we articulated in the proposed rule that the purpose of the reasons for having that working capital provision, and to the extent that that doesn't work, the more that you could tell us about, you know, about to address those concerns that we have that prompted the working capital requirement, you know, the better. So anything that you all have to say about that would be very helpful. Okay.
Yeah. The one place that I'd look if I were you is I'd look at, you know, the ability of the entity as a whole, or that particular single asset entity, to meet its short-term obligations. I think that's really what you're after.
Yes.
And so, you know, what I'd be exploring, or what I'd recommend, is that, you know, to the extent that you have a facility that enables you to make those short-term obligations, that you've satisfied that working capital, that it's not merely as a result of operations.
Okay. Thanks.
I'm Jeff Stein from Capital Finance, another working capital lender. Just wanted to reinforce again what Patrick had said earlier. I think the whole industry, there's a bunch of us that have gotten together and already spoken, and just feel very strongly in what Patrick said, and in the possibility of perhaps having some type of breakout session for the working capital side. You know, since we implemented from 6 years ago the changes and stuff with the intercreditor and the rider, it's been a very successful program. It's worked well for both us, the operator, and for HUD. It's strengthened HUD's position by allowing the operator to have working capital. There are a couple other things. One of the keys is also where the working capital lender would no longer be named lost payee. And we've had, I think all of us have experienced certain times with some of our operators where, whether it be a natural disaster or whatever, where that money comes in, the insurance proceeds come in for business interruption, and have allowed us to continue to lend until the situation is corrected. Also, getting back to this issue about working capital as far as the ratio, perhaps a better way of testing might be more of a cash velocity, because typically the operator has working capital line of credit. So if you really look at the cash position plus their availability on the line versus just looking at a true working capital, you know, ratio, that might be a better measurement.
Can you repeat that last point?
The cash velocity, which would be your cash and then your availability on the working capital line that you have, using that as a test versus the working capital, just your standard working capital ratio. I think, as Dominic said, you know, as an operator, it's just, there's the ebbs and flows. It just, you know, I think that's just a tough ratio for anybody to really follow.
Basically looking at what you have available through your accounts receivable.
Yeah, yes.
Okay, okay.
Thank you.
Okay, we have a question or a statement through email. Sarah.
Linda Creeder asks, is there a pro forma calculation of the debt service reserve account that will be required?
And we have not set that forth in the rule. And as you know, we have a handbook that would be coming forth. We had anticipated after the rule, and so we would speak to that matter in the handbook. And you know, we still would certainly welcome your comments as you've been giving us today regarding how that calculation be made. Whether several of you have made suggestions, you know, based on the assessment of the risk and so on. But we have chosen not to put that at the rule stage, consistent with what you were saying, Steve, about having some flexibility. So.
I said I'd get up again. I'd like to continue to follow up on the debt service reserve. I think one thing that kind of has gotten lost is, at least from the properties that I've seen that have been troubled, in general, what happens is there is a significant period of time from the time of default when the mortgage payment stops being made until such time as an assignment actually occurs. There is already plenty of time given, working with the troubled asset team and working with others. There's already time given. To the extent that an additional 2% of mortgage proceeds, which is about what a 6-month debt service reserve would be, would benefit, I don't really believe that that is going to be the difference between saving a default and not saving a default 10 years down the road. By and large, the debt service is one of the smallest pieces of expense with regard to a nursing home. If you have a better way of controlling payroll and food costs and therapy costs, that's probably more worthwhile. I think that to put a debt service reserve in on 1,400 properties or 1,600 properties, however many you have, in order to save, I don't even remember how many defaults you've had this year, 5, 10? You're placing a burden on 1,400 to save 10, and I don't even think that the fix saves the 10. It might save 2 out of the 10. So the fix is wildly disproportionate to the benefit being gained. The second concept is, if there has to be a debt service reserve, it should, like most mortgage insurance programs or whatnot, or like many private debt service reserves, burn off at a certain level, 75% LTV, 70% LTV, pick it. But it should have some place where it burns off. There is no place for a debt service reserve at a 30% LTV loan or a 50% LTV loan. It just doesn't make sense. With regard, just to echo, I'm not an expert on all the AR financing, but I've spoken now with several AR lenders, and I have 3 lenders who have told me they will stop participating in the program if the rules stay as they are, and I've only spoken with 3. So I would imagine that speaking with others, I will be able to increase that tally.
Steve, if I may, in terms of the debt service reserve, which as we have set forth, would be a long-term debt service reserve for the life of the loan, and you mentioned having it perhaps having it cut off when you get to certain debt service or a debt coverage level, or actually a loan-to-value level. As you've seen, when a property's in trouble, the value drops off precipitously. Does that affect does that affect your position on this at all? I mean, have you seen with troubled projects, if the license is at risk and so on, the value is dramatically diminished, and the troubled team is working to try and get that property turned around, whether it's with a change of owner, change of operator, what have you, and that takes time. And the lenders, of course, have to keep making their payments every month, even if the borrower is in pain, and there's only so long they can hold on. And those are the concerns that were articulated in the rule. But can you speak to that?
Yeah, of course. First of all, the LTV test in my proposal there would be based upon a fixed amount of time, based on your amortization schedule, and based on the value at the initial point. The second factor is that, as I said, the amount of the debt service reserve, whatever, because you didn't define it, I can't say whether it makes sense or doesn't make sense. However, if your debt service reserve is 6 months debt service, just as an example, okay, you've got a debt service component. If you have a building with a a $10 million building, it brings in $10 million in revenue a year. Okay, it's worth about $10 million on a skilled nursing facility, give or take. You've got an $8 million loan on that same building. 6 months of debt service is $400,000. Okay, you can't replace a 10% drop in $10 million in revenue with $400,000. It's generally when you've run into trouble with a building, it isn't at the margin. It is a permanent problem, or it's an operator problem, or somebody who has to be kicked out. Okay, you don't run into problems, at least what I've seen with the troubled team, with deals that now are running at 0.97 debt cover instead of running at 115. You run into a problem where it's running at 0.5 debt service coverage, or where it's running with one that I'm trying to work with that the troubled team brought to me at 0 debt service coverage. Okay, you can't have a big enough debt service reserve to fix that. And as a result of that, I don't think that the debt service reserve being proposed, unless it is enormous, at which case it's a problem, will actually fix the problems that you've seen historically. And I'd like to know, although you can't comment, whether that analysis has been done. Because based on what I've seen, there isn't any amount of debt service reserve that's a reasonable number that would have actually made the difference.
So if I could just ask you to clarify, because it seems to me what your comment has said, that when a deal gets into trouble, the amount that it's in trouble is such a large margin that the debt service reserve doesn't cover that. But it seems to me like you're talking about the loss of the operating income as opposed to just maintaining the debt payments during the time of the greater workout.
Well, I can't imagine that your point when you have a building that can't make payroll is to continue to collect debt service. I mean, that can't possibly be the use of the debt service reserve. If you have a building that can't make payroll and the owner has no further resources, that's the only point when this comes into play. The owner has no resources, and you have a building that cannot make payroll because payroll is $1 million a month, and debt service is $200,000 a month. Mm-hmm. You're not about to say, don't pay the employees, pay me my debt.
I think the rule says that. I think the rule says, because we're trying to hold off on foreclosure, if we can continue to pay the lender to keep them from foreclosing, then we can have a time to work out getting in a new operator or whatever else.
Two things. First, no lender forecloses. Okay.
No what? What did you say?
HUD lenders don't foreclose. We assign.
Or assignment.
All right. I'm sorry. One lender forecloses. Most lenders assign, okay, which buys time in and of itself.
Not for us.
You have an assignment, but you still have a building that's operating, and you still have 90 patients in that building who are alive. Mm-hmm. Okay? If you decide to use the money from a debt service reserve, if you're that close where it's the debt payment is the only thing not being made, then I don't think that's where your troubled team is looking at deals. John would know better than I, but the ones I've seen have been further upside down than that. And in general, lenders try to work for months and months to get to a point where there can be a solution. So I think that the debt service reserve, if you're going to put 5%, what's your balance now, $14 billion, $15 billion? So you want to have, what, 5% of $15 billion? So the number is $750 million bucks. Is that right? $750 million. You want $750 million, if you could retroactively apply this, $750 million in debt service reserve applied to the entire portfolio in order to save, what were the defaults or the assignments this year and the losses on them? Overall, $30 million bucks. So $750 million in cash, not earning any money because rates today are at 0.2%. And I think Chuck's assessment of a fly with an atomic bomb sounds about right.
Okay. Thanks, Steve.
I also wanted to just follow up on, Steve, on your comment that and to the other AR lenders, we've gotten a little bit of feedback as to, if the rule stands on right now as it is, then AR lending basically shuts down. But again, it's helpful to know what specifically we could do to keep AR financing viable, and what specifically it is that makes it unviable. I know we've gotten some comments to that extent, but generally it's less helpful to say, if you don't make any changes, then we have to shut down.
I'll defer to the AR lenders, of course. However, the one major complaint that I've heard now 3 times is the flip of priority collateral. The fact that there isn't a 30-day window. Nobody's perfect. If all of a sudden somebody lends and they just missed the notice that came from HUD and they've now lent against money that they now have a second lien on, they lose their job, so they're not going to take that risk. It was tough enough for AR lenders to swallow a 30-day flip on priority collateral, a 0-day flip. That's the number one issue I've heard. There are, as we heard, many others.
Thank you.
Good afternoon. I'm Rick Price with Stiefel Bank and Trust. On this whole issue of debt service reserve fund, you go back in history when you look at the bond market, and as S&P and Moody's, and to a certain degree Fitch, have rated healthcare deals in the past. And I'm not a bond attorney, and there may be some here today, but there's always been a debt service reserve fund in a structured deal that's been rated, that has an investment grade rating. So billions and billions of healthcare facilities have been funded over the years with debt service reserve funds that last to the term of the bonds. And that may be a controversial statement here today, but it's a fact. Where the rating agencies have worked successfully in the past is incorporating what they call a springing lockbox in the event of a problem. And that's where the trustee in these particular cases has stepped in and begun to control cash flow. And somebody mentioned earlier the waterfall. Well, that's where the waterfall comes into play. When a springing lockbox is incorporated and funds then are controlled for specific purposes. Number one, to keep the project operating successfully as possible, and then paying debt service, interest first, principal second, down the line until such time as there's a stabilized period. But that springing lockbox also allows for debt service reserve funds to be reduced over time as certain measures are taken. So what I would suggest overall here is maybe some collaboration or some discussion with the industry and with the rating agencies on how they've done it in the past, and look at some of those trust indentures that really describe a functional springing lockbox, as they call it, and how that interrelates to a debt service reserve fund. It's been successful in the past, and it may be something that HUD might want to think about. Okay?
Brian Pollard, Lancaster Pollard. I just wanted to make a general comment, and that is that, I think by any metric, the LEAN program has been a wild success. And what you guys have done over the last 5 to 7 years has been quite remarkable. And that, in a combination with, of course, record low interest rates, has produced not only this incredible volume into the program, but it's allowed you to attract a very high level type of operator, best in class type operator with best in class assets, which prior to LEAN were not coming to the HUD program in mass. I think as you look at mitigating risk going forward, and that's surely what these changed regulations are intended to do, it's got to be a balanced approach. We're all for updating regs. We understand they have not been updated in quite a number of years. We're all for mitigating risk to the program. But those changes that we make to the program cannot deter some of those best-in-class operators, because at the end of the day, that will have a negative consequence, because those operators are an important part of spreading that risk out amongst the general insurance fund. Okay, so that's a general comment, but a couple of specific things. you know, everyone's commented on the debt service reserve fund, and I do believe that that is one of the most challenging changes that you're planning to make. You know, Rick is right. The capital markets do use debt service reserve funds, but the capital markets do not limit those to a loan to value. So they are always funded out of bond proceeds. If we end up with a situation where borrowers have to fund the debt service reserve fund out of pocket, even a portion of it, I think it's really going to limit the appeal of the program to those borrowers. Second thing is that ownership in this industry is highly fragmented. It varies considerably from the mom and pop owner to the very large, sophisticated, vertically integrated organization that provides ancillary services to their properties, therapy, pharmacy. There are a number of provisions that require HUD to approve either salaries or payments, you know, to owners who are actually providing legitimate services. Maybe they're serving as the administrator of the property, and also requires HUD to approve payments to those related party ancillary companies. And I just don't believe that's something that HUD really wants to do on an ongoing basis. I think that, you know, that's, especially if, you know, if there's some form of this working capital requirement that ends up in the final regulation, you know, I don't know why you need to get approval for payment of either payment for goods and services or payments of salaries to those that are providing legitimate services to the properties. Final comment is that it's very difficult now. As you know, the OPCO-PROPCO structure is very prevalent in the long-term care industry. It's very difficult as it stands now to do HUD transactions with non-related operators. So if there's not an identity of interest, the requirements of the HUD program on the non-related operator are extensive right now, and it makes it very difficult for us to bring those type of properties into the program. With the changes that you're proposing, it's going to make it even more difficult. Some of these changes that you're imposing on the operator will just make it a non-starter. And those represent, you know, some of the more, can represent some of the more sophisticated operators across the industry. So I think we have to bring all of those into consideration. Okay. Yes.
Do you have suggestions of what changes you would recommend that be imposed with regard to operators that would you know, better protect the insurance fund, but that would be that you think would not be would be more feasible than what you think some of the
you talking
proposals.
about the non-related? We're talking about the non-related
yes,
owner operators
primarily.
Well, I mean, if you look at the GSCs.
But hang on, Brian. Even related operators, because a lot of times the related operators will still have the same. You know, they will still at the operations level they'll be handling multiple facilities and not have segregated funds and so on. Right. So anyway, I'm sorry. Go ahead.
Well, I mean, if the question is related to non-related operators, you know, the GSCs rely upon the enforceability of the lease, and you know the lease is they draw comfort in knowing that those lease payments have to be made, and as long as the lease payments are made, then the real estate owner is going to be able to make their mortgage payments, and if the operator you know, defaults on their lease, then you have the ability to bring in a new operator. And so having to control the operator that closely when they're a non-related party is not something that is consistent with other funding sources.
Okay, thank you. And I have one other question with regard to debt service reserve. That, you know, a number of you, Steve, I think you said, well, if it was 6 months and so on, and Brian, you didn't mention a specific time frame, but is there, you know, and this long-term reserve, as we set forth in the rule, would be not for problems that would be anticipated early on, but for, you know, problems that might come up many years down the road. You know, and obviously there's been some discussion about that concept and whether that's a concept that one subscribes to. But is there is there an amount that would you know, Steve mentioned 6 months. Would 3 months be something that, you know, in other words, 3 extra months of workout time for the troubled team and the lender and so on?
Yeah, I would say 3 obviously is better than 6. But the other thing that we've got to remember here is that HUD, with the lien program, HUD has done a wonderful job of improving its underwriting. You know, we have a more consistent underwriting program in place, and I think that's producing exceptional outcomes. I mean, all the statistics that I see from the department are that you're creating record volumes, but you got record low claims and losses. I mean, any creditor would love to have that fact pattern, right? One of the areas that has been probably lacking, and is an area that we support, is that post-closing surveillance. I mean, I think identifying deteriorating trends as soon as possible is important, because if you can identify them early, you know, hopefully you can implement solutions before the property is permanently impaired. You know, we've never had the ability to monitor these post-closing on a quarterly basis through the HUD documentation. And so I think that's an important change, but it is going to give us the ability going forward to identify, and for HUD to identify, deteriorating trends sooner, so that plans of correction can be put in place so that you don't have to rely upon a debt service reserve fund. Okay?
Thank you.
Finally, Len.
Hi, Len Lucas from Love Funding. Without going into all the platitudes and everything, I would like to thank all my colleagues here for some very thoughtful comments, of which I don't know that there's much that I disagree with. And I would also, it should be said, it should not go without saying, that there have been a lot of improvements in the program, which we haven't seen yet. I think the fellow over here was saying that a lot of things have come in to play in the last couple of years that we're not reaping the benefits from, that may obviate the need for some of the changes being made today. Specifically, I'd like to address the debt service reserve. I think we have a debt service reserve. It's called the MIP. I mean, when I go and talk to a customer, you know, they're paying 0.45 every month that goes into a fund to mitigate any losses that the program suffers. And in addition to that, I think that we need to be cognizant of the type of lending that we do and the borrower that we deal with. I mean, we give 35-year fixed rate financing, okay, to people that have to have a minimum 145. Most of the deals today, I mean, 2 is not unusual, 3 is not unusual to see in terms of debt service coverage. We don't give them any cash out. We tell them we want them to sign a master lease, but we don't allow them to bring another property into the portfolio that doesn't meet standards that have already been increased. So, you know, you go and you can say, well, a lot of the conventional lenders out there impose debt service reserves as a matter of course. But those lenders will also say, okay, you've got a dog, we'll put the dog in the portfolio, we'll cross everything, and we want you to write a check. I mean, you can sell that to people because they're getting something for it. When we're bringing in borrowers that are coming in with top properties, it's hard to ask them for a debt service reserve. So you need, I think that I would ask you to think about that when you think in terms of putting out a rule that says we're going to have a debt service reserve for everybody. There are certain types of properties. We don't allow forward-looking appraisals. You know, there are other lenders out there that will tell you, I really don't care what, you know, we're going to have an appraisal done. I don't really care what it says. This is the deal you're going to get, and this is what it's going to cost. We can't deal with those types of borrowers. It's just not, it's not there. So what I'm trying to say is you're not necessarily getting something for the reserve. Lastly, although I'm not overly familiar with bond deals, one thing that I have seen when you see bond transactions that have debt service reserves for the life of the loan, the proceeds, you know, the type of deal that they can put together in a bond is something that, you know, we don't talk about over here. I mean, they can go to very high leverage levels and put anything together that people will buy that are not the type of deals that we bring here and not the type of borrowers that we bring here. I'm not advocating for that, but again, it's a situation where the debt service reserve is there, but it's serving a purpose that differs from the vast majority of the acquisition refinance transactions that we look at. Thank you.
Thank you.
Hi, Chuck Bissinger again. Just following up on a few things that have been said. On the debt service reserve, I'm not a big fan of the master lease, but I think that the debt service reserve and the master lease is a little more too much belts and suspenders. And obviously some cases don't have a master lease, maybe most still don't. But to impose a debt service requirement on top of a master lease is essentially attacking the same problem twice. Maybe you give people a choice. Following up on the comment I think that Steve made, and I sort of alluded to it in my earlier comments, is that the number of projects where you have enough cash flow to cover the operating expenses but not the debt service is going to be very small. That's a very rare event. And the idea of putting $750 million, I hadn't really looked at it that way, in escrow for the 3 or 4 times in the course of a year that might matter seems really like the atomic bomb with the fly. So I think that there hasn't been a really good, in my view, cost-benefit analysis from HUD's point of view as to whether or not that is always the right thing to do. I do think that there's a proper place for the debt service reserve, but I think that it should be more selectively applied. The other thing, and I understand, and I've been through lots of times when there's been defaults and working on cures, not really in the lien context because the defaults are so rare and the program is new. And John, I understand very much your point about wanting to have time. Under the existing rules, and it came from Mortgagee Letter 87-9, and that was codified ultimately in the rules for multifamily. I'm not sure that it was actually codified in the rules that are proposed here for the 232 program. But HUD has the ability to basically require that the mortgagee request extensions of time before filing a mortgage insurance claim. And I think that a much better way to focus on this, my lender clients may not necessarily all agree with this, is to revisit that and impose upon the lender the requirement to request extensions of time to make an election to assign if HUD believes that additional time that will give the breathing room to affect some sort of sale of the asset or some other thing before the loan gets assigned to HUD. I mean, I think that's a good point. And you ask about how to attack this problem, and your issue is once the loan's assigned to you, it's kind of over. And you want to keep the lender in the saddle for a while. And, if the lender makes a loan and it goes bad and they have to fund the monthly payments on the Ginnie Mae security for a few more months to give the thing a chance to solve itself. I think that's where you're putting you're looking at and saying, which are those 3 or 4 times a year where it matters? Let's buy the 6 months on those 3 or 3 months on those 3 or 4 deals and not take the other 1,500 deals and drag them into the mess. So I think that, in terms of trying to be a constructive option, I think I'd look hard at that. I think it could work.
So you would look hard, when you say look hard at that, you're talking about looking hard at requiring the lender to hang in there longer.
Right.
Okay.
And from the lender's standpoint, it's largely a cash flow issue because if there's ultimately a cure, then the lender gets made whole. And if the loan's assigned, then HUD's going to pay for the additional interest carry in the mortgage insurance claim. The next thing I wanted to mention was, and a couple of people made the comment, I think Brian Pollard did, I think there's a perception that in the new regulatory agreements that HUD is going to micromanage the operators. Some things have been specifically mentioned. If you want to hire your sister as an administrator, her salary her compensation is going to have to be approved by HUD. Okay? If you want to hire your grandchild, and you know, a lot of these are mom and pop businesses where the people working, you want to hire your grandchild to work there for the summer, you know, you're going to have HUD approval to do that. Okay? And if you want to pay your grandson $10 an hour, then some account executive somewhere is going to have to decide, you know, is $10 an hour a fair salary for some kid who's emptying, you know, bedpans in a nursing home, okay? One of the real strengths of lean, I think, and what was discussed at the beginning, was to focus on what's important, to focus on what matters, to look at the issues that really can decide the success or failure of the enterprise. Whether somebody's kid's getting paid an extra $1 an hour, whether your sister's being paid a couple $1,000s a year more than a typical administrator might get paid, that's not lean to be thinking about those kinds of issues. You have a provision, I know Kathy has already told me not to relitigate anything that came up in the multifamily documents. And so in the multifamily documents, there's a statement, and it made its way into the regulatory agreements here, that the obligation is to obtain goods and services on the terms that are most favorable to the project. Okay? That means that if I want to hire my sister to be the administrator of the nursing home, I have to pay her on terms that are most advantageous to the project. Now, that's a little bit vague, most advantageous to the project, but you know, if somebody hires their sister as an administrator and pays her $800,000 a year, probably that's a problem, and I don't think that it's going to be hard to prove. If they hire the sister as an administrator and they pay her $2,000 more, it just doesn't matter. It's just not important. And we talk about the emphasis on risk mitigation and a lot of talk about the debt service reserve and focusing on preventing problems and solving problems. We don't want the account executives having to micromanage these properties. And there are a number of things, I'm not going to start listing them all here, we'll make written comments. But I mean, the point I'm making is you've got a couple of very broad general protections that you have. And you should focus on those, and you should free up your staff to look at the financial statements that you're getting every quarter, to review the survey reports, to be identifying the problem assets and focusing on them, not spending their time, you know, processing a never-ending request of approvals that are not very important. The last thing I wanted to mention in this go around here was I was kind of disappointed myself to see in these rules that there is not a thoughtful distinction between identity and non-identity of interest operators. To me, these are really two different sets of issues that require almost two different sets of rules. When you have a non-identity of interest operator, the mortgagor is your best friend because their equity in the real estate is between you and the operator, okay? And, you know, you can really, you know, if you've done a reasonably good job underwriting the deal, you know, that's going to give you a fair level of protection. And some of the other requirements that you're seeking to impose on the operator you don't really need because the mortgagor is just going to take care of things for you or take care of things for the lender. As has been said a couple times, and I see this like, you know, mostly right now like with A7s, where we have an existing HUD project with a third-party operator, and we're trying to do an A7 because they've got a 7 or 8% interest rate, and it can be a tremendous benefit to everybody to get the A7 done. And we can't really get the operators over the fact that they have DACAs and DASAs and accounts receivable financing limitations, and now we're imposing all these things on them. And when you look at what's coming here, we're taking the next step in a lot of ways. Right now, under the lien program, we're requiring the operators to grant a security interest in their assets, accounts receivable and personality, tangible personality, to secure their obligation of the lease. Now they're going to be pledging those assets to secure the loan. So the operator, this third-party operator, is becoming a de facto guarantor of the loan. They're not going to want to do that. I mean, it's going to be very hard to get them to do that, and they are unlikely to do that. They're going to be very hard-pressed to, especially some of the larger operators, where they have third-party arrangements, third-party services they provide themselves, like pharmacy and therapy, and the bidding process and so forth. So I think that there's a general step back on that because I think you're going to eliminate a lot of deals that you don't want to eliminate.
Thank you, Chuck.
Hi, Amy Heller from Capital Source. I'm another working capital provider, and I'm just going to add to what Jeff said and Pat said, and also I haven't spoken with Steve, so I'm number 4. Who won't be lending if all these changes go in. And I do know there are just a whole host of us, and that sort of view these changes as problematic. And I would also suggest that, I think the way it works now is actually working for all of us. And I know that I wasn't involved in the process, but there was a lot of thought that went into the way the documents are drafted right now. And so I would ask HUD to think about whether or not there are circumstances where the documents are, not working, or the working capital lenders aren't doing what they're supposed to be doing, because I would hope that my colleagues, and I know the ones in this room, are doing everything right. And I do think, as Pat said, that we do have a lot of aligned interests. Just to point out a few more things that I think the others didn't mention, one of the things that you all are requiring, I believe, in the proposal is that for a number of amendments and modifications that you all approve or consent to, each of the things that we do to our documents. I can tell you day to day, there are so many things that we may have to do that maybe, go at warp speed, that I don't know that you all want to have the infrastructure that would be required to simply be signing off on each approval and each amendment, maybe a waiver of financial covenants. I don't know that that necessarily falls into what you need to do. I can't remember exactly, but there are, just a number of things that have to be done and have to be done timely. So that's one of the things that I think could be problematic, particularly, for instance, you say you would need to sign off on advance rates. I don't know if the advance rate definition would match up with our advance rate definition, but I can speak, again, for my colleagues in the room. We do 2 different things. One, we apply an advance rate when we close a deal. In addition to that, we monitor how a particular borrower is collecting their receivables, so we apply what are called liquidity factors or dilution factors, and those change from time to time. And so the better people are collecting, the more we'll lend. The worse people are collecting, the less we'll lend. And we modify that throughout the term, and we want to be able to switch that through our collateral monitoring very quickly. And I think you want for us to do that as well. So that's one of the things that I think is a little vague. Next, I think you talk about protective advances, and I think the way it's stated in the documents, we can make them, but we have to give you notice after 1 day, and it says that they have to be reasonably necessary. Well, I don't know that I want to be sort of determining what's reasonably necessary by nature of a protective advance. The only reason I'm going to make it is because we think the facility needs the money. I'm not going to want to make a protective advance, whether it's out of formula or over my facility cap or whatever it might be, just because I feel like doing it. It's going to be because there's an imminent issue, a payroll, a vendor that has to get paid, a something that has to get paid, and it may well be rent. And then I would, sort of speak to Dominic's point on the accounts for a moment. He talked about the structure and the cumbersome structure. I believe that the way you all have proposed the account control agreements, you have to use the exact form. I would say, first off, banks are not willing to simply just take a form. It requires negotiation. I think the way it works now is you all have a number of items that are required to be included in the account control agreement, and then we work off of that and make sure that they're included. I think the other part to that that somebody like Dominic would be sensitive to is the banks don't want to be doing this. They're doing it as an accommodation to have banking services. Maybe somebody with 60 or 80 homes are able to do it. I can tell you for the mom and pops, I hear that banks typically charge $1,000 per month per account to have this accommodation. I would think that everybody would want that, you know, in the business or in the CapEx or whatever it might be, rather than simply going to a bank. And then finally, the other thing I just, you know, want to mention is that I think what's proposed is that HUD has the ability to amend our UCCs as the working capital lender, and I would just simply state that that's something that no commercially reasonable lender would want to allow for. That's all I have. Thank you.
Good afternoon. My name is Watt Taylor. I'm kind of a lone wolf here. I'm primarily acting against borrowers' counsel typically, as opposed to lenders' counsel. So, but I wanted to kind of give you some perspective in that regard in terms of trying to, first of all, explain these proposed changes to our clients and looking at them in terms of their perspective of what we see. Much of what I'm going to say has already been said, so I won't go over it too much. But in first trying to explain these changes, and after getting, first of all, over the hurdle of the fact that our healthcare clients, of course, have not seen the multifamily changes. So, number one, having to get through the hurdle of explaining why they're signing on paragraph, I guess, or part 38 now instead of part 50 of the multifamily documents. But then going through the various items where, particularly on the operator side, that I feel that there are some situations that maybe things have gone too far. I understand that HUD has a vested interest in making sure that you have good operators with these facilities, but more often than not, we do represent identity of interest operators. But I think, as has been said, I think the option of using a third-party operator is going to be pretty much gone after implementation of the regulations and documents as they stand now. And I do think that there is a over-excessiveness, basically, of looking into, as Chuck has said, looking into the operations of the business. I understand, again, an overview and some of the things like providing quarterly financial statements. I think things like that may be legitimate and may give HUD already the opportunity to see some of the things that they otherwise are asking in addition to that. I think we've got, as was said, a multitude of belts and suspenders in a number of cases. Just a couple things, and I'm not going to belabor the debt service reserve issue, except to say, particularly where there is apparently an allowance, it seems that an owner may be, if you hit your debt cover, that you may have, actually it is coming out of your own pocket. And I think the nervousness of having to do that, and then at the same time not having any clear guidance as to exactly when HUD, in its sole discretion, may or may not decide to utilize that debt service reserve, is a pretty spooky thing for a borrower or operator to kind of consider at that point. The other thing is we have a number of clients who have projects that are very well stabilized, have good operating cash flow and whatnot, and looking for maybe have a relatively low debt cover. And in those situations, as has been said, I think and I don't have the magic, amount, but as been said, I don't think it's needed necessarily for a solid project facility to have a debt service reserve just because it's applied in every situation. Obviously, there's movements, as there has been on multifamily, to move things to single asset. We understand that, and I understand that. But I think the documents should reflect some flexibility. There are situations where it may be appropriate to allow for something other than a single asset. Even in the proposed reg itself, it acknowledges that public agencies might be able to own nursing homes, but then turns around and says you need a single asset entity. Well, many public agencies might not have the authority or ability to create a single asset. So I think the documents themselves, the definitions of, for example, operator, I think in the operator regulatory agreement starts out saying be a single asset entity. A simple, except as otherwise approved by HUD, would be a simple fix for that. I think a lot of the things that have been talked about in terms of getting approval for compensation for principals or affiliates of principals, which are incorporated into the definition of principals by their own terms, causes again, some overlooking some of the in distributions, not allowing distributions where you might have gotten a notice that you may, in fact, violated or be in violation of a government requirement. Well, that may be a very minimal context, but that in of itself, is that enough to reach that threshold? Another area is in the operator regulatory agreement, and I think it first filtered into the master lease and subordination agreement, but now applicable to everybody, the use of consultants potentially. If you've got a troubled property and you want to look at consultants, the regulatory agreement basically says that you have to comply, at HUD's discretion in determining and approving the consultant's recommendations, that the operator is required to comply with that. No ifs, ands, or buts. Whether there should be more flexibility in that regard. And speaking of flexibility, one area that has already been mentioned, of course, is required now in every situation already, the DACA and DASA situation. I think it must be understood that those forms, when they go out, in the format they're going out now, the assumption by certainly field counsel that we've dealt with is those are the forms, they can't be changed. Well, in numerous cases across the industry, your larger depository banks, we've worked out DACAs and DASAs that work with them specifically, and they're different. Bank of America requires a guarantor, a non-borrower guarantor. So there's a variety of types of DACAs and DASAs that the industry has already kind of laid out. And to implement those and say those must be used, again, it causes some real difficulty or grief. So again, flexibility, I guess, is the key of my comments. I think that's about it. I guess I'd echo everything that people have said, but from a borrower's perspective, it's particularly difficult to explain some of these that seem a little bit far afield, and we'll explain more in our written comments about more specifics. Thank you.
Thank you.
I just wanted to follow up on one point. I know we're hearing as a common theme the difficulty that these regulations will add to third-party operators. And I don't remember who said it, but someone commented that already HUD sees less third-party operators maybe that are in the field. I don't have a sense of, I guess we're only looking at what's coming into our portfolio. So do you have a sense of non-HUD transactions? To what extent are third-party operators prevalent, right? So if in the HUD portfolio we have 3% unrelated operators and 97% related operators because of our rules, are you trying to say that that is not typical for broader portfolios that are not government insured? So if you, in your commercial lending, if you see something closer to 50-50 related operators and unrelated operators, I think that kind of information would be helpful. Because I don't know that we necessarily have that kind of information. We can only see what's in our portfolio.
Does HUD even have any information about what percentage of the HUD portfolio is identity of interest versus non-identity of interest? I bet not. What I can say to that, Kathy, is I have been on many phone calls over the years where you have a borrower, and if you're doing a new construction project or something like that, and the operator is coming in on the ground floor, it's like, hey, you want to be in the deal? These are the requirements, okay? But, what happens is you've got somebody who has a 30-year lease that they signed 7 years ago, and they had some conventional financing, and now they're seeking to finance the loan with FHA mortgage insurance. And they have to convince this third-party operator to agree to amend their existing contractual relationship to accommodate the FHA financing. And people in this room sat on calls with attorneys for operators who said, well, what do you mean I have to get HUD's approval to alter the building? Okay? What do you mean I have to pledge my accounts receivable, in connection with your financing? And so many of those times, the outcome is that they just don't do it. So, what I see from my perspective is a significant number of transactions that would have gone forward but don't because the operator declines.
Yeah, and I think that's really helpful feedback. And I'm wary, though, of making the rule for a couple of minor exceptions. It's a shame that deal couldn't go through, but when we're looking at trying to allocate government time and resources to try to make these rules, if we're just not going to catch everything. So, are we talking about 1 or 2 deals? Or are we talking about 50% of the market that we're excluding? So, that kind of feedback in relation to the comments on the third-party operators would be really helpful.
When you, without having a pure census of the entire market, okay, Brian is here saying 40% of his. I think that's an even number for me. When you really look at it, 3 of the largest nursing home companies in the United States are independent because 2 of them are owned by REITs and 1 is just an independent. You start to deal with, whenever you have a REIT in play, that's an independent owner-operator. Okay, at this point, REIT borrowing costs are so low that HUD is not viable even at today's rates. But that's not always going to be that way. There are plenty of independent owner-operators, even when you get into assisted living and even beyond the skilled nursing area. I think that the key thing that I came up and I started firing from day one or from second one at this meeting, and that's not really fair. One of the things I want to make sure that gets across is that the advances that have been made in the last 3 years with regard to, or the last 4 years, with regard to how HUD financing of healthcare facilities has been processed and how the collateral has been taken care of are really strong. We've gone to 80% LTV. We've put springing lock boxes in place. As Rick said, those are there. Springing lock boxes are now in place. Okay, that's better than a surplus cash requirement. That's better than project working capital. Okay, you can now go in and actually grab the cash. We have AR financing that's approved that enhances collateral. We have master leases that are approved with significant provisions for allowing people to fix what's going on instead of just simply foreclose. Used to be you couldn't do a thing with a tenant until it was too late. Now you have plenty of moves to keep going. You mentioned, Kathy, the use of government resources. We started closing a relatively large portfolio a little while ago, and the HUD asset manager called me up and said, am I going to keep getting all of these reports that I'm now getting? The answer is, yeah, you are. Okay, that you started getting every time there was a complaint survey with anything on it, anytime there was an annual survey with any finding, that survey went in, then the response went in, and then the response back from the state went in 3 times. Okay, 3 PDFs that kept coming, and her comment was, I can't read all this stuff, so I'm getting hundreds of pages of information that I just can't read. Okay, your protection comes from the lease. The operator makes the lease payment. That's independent or non-independent. You have a DACA, you have a master lease. If you have an operator with multiple facilities, you can kick them out of every single one. That's the best protection you've got. The second best protection you have is the DACA, which all of a sudden, as soon as they default in any way, you get all cash coming in and you get to decide where it goes. Better than any surplus cash provision that anybody ever had. You don't have that right anywhere else. The segregated operator accounts, so long as somebody can account properly, as Dominic does, and as almost everybody does, within their systems, then that you've already got the protection to understand where everything goes. You get your security. The segregated accounts are a throwback to days before computers. And to not recognize the fact that GL systems are adequately set up to be able to segregate and produce financial statements on an individual basis, even if all the money is sitting in one bank account. It doesn't matter what account it's sitting in. It matters that you can identify that this cash, that this facility has this much cash, made this much money. The advances that have been made in the past 4 years, and Ed referenced it, have done a lot to improve the security and collateral of this portfolio. And through some of the most difficult times that we've had, from a recession to Medicare and Medicaid cuts to challenges to reimbursement across the board, defaults are still shockingly low. Okay, there is success in this program, and there was before, and it's only better now. A lot of these changes are flat out unnecessary. They are duplicative of other provisions, of master lease provisions, of DACAs, of DISAs, of AR financing, of lower leverage, etc. Trying to drive away or trying to put some of these additional provisions in, it's overkill. You've already done it. We just need to codify, we just need to have codified what has been in place for the last 2 years. What's been in place is good, it works, it provides protection. And that's where that's what should be codified, not new regs, not new rules. That's it.
Thank you.
Get up again, this might be the last time. But again, to add to what Steve is saying, we touched on the master lease, the AR financing. Again, those are all protections, but even on the underwriting side, you require risk mitigation or risk management for pretty much every facility. You're getting state surveys almost on a real-time basis. You plugged into that TSA database, so you're getting that information up front, so you're able to, you and the lender is able to address a problem as it relates to the quality of care pretty quickly. You're already getting quarterly financials. We're getting quarterly financials. We're now doing replacement reserves at a pretty hefty rate. So we're making sure the physical plan is well taken care of for the life of the loan. And any asset that has that's an older quality of building, you're shortening the loan term. And we're making that recommendation as well. So we're, again, on the underwriting side, we're covering all of these things right now. So I think, again, I think we need to give time to let some of these protections take hold. And as it relates to the single asset operator, and there are a couple, there's an operator in the room, but I believe that there are certain states that if you have to change an owner to a single asset, or change to a single asset operator, that would trigger a new CON, which again could a change of ownership, which would again incur significant legal fees.
If I can just add, you know, a lot of the protections that were mentioned that have been made over the recent years, you know, those will of course require, utilizing those will of course require work on the part of the lender, you know, because it's going to be work on the part of the lender to take action on those if it's going to prevent an assignment. Okay.
I want to start with talk about that a little bit. And since 1993, we've taken back 4 projects, and we haven't assigned them to HUD. Worked them out, we fixed them, and all 4 of those projects were regulatory problems. Debt service reserve, although it would have helped us with the amount of cash we had to put into them, would not have stopped defaults. The health departments in those various states were kicking these operators out of the properties. So debt service reserves would not have helped on any of our previous defaults. One thing that we were forgetting about, you know, we have these tort litigation problems, and it still occur, you know, although it's settled down from where it once was when we had to implement policy. There's a few things in here that I want to understand where you guys are going with, because they could cause additional tort litigation issues. And the first one is, John, I want to understand what you mean about a new management agent certification, because most operators have gone, the management agent certification, most operators have gone away from having a management contract and have specifically bookkeeping contracts and nursing consulting contracts, such that those companies are not responsible for providing care in the buildings. So I want to make sure that doesn't change. That's a tort litigation issue.
If I may, there are, particularly on the assisted living facility side, there are situations where there's not a separate, you know, the owner is the operator, if you will, but they have a management agreement with an entity that does the overall management. That's a more, we're seeing that much more commonly on the ALF side than on the SNF.
Right. Yeah, if there's a real management contract in place, I'm comfortable with that. But if there's a separate consulting contract for nursing services where these companies are not responsible for providing care in the facilities, those are not management agents. That's the way we've been doing things under lien, as long as that's not changing. Talk about risk management and requiring a risk management program. Risk management is underwritten. We underwrite it as part of our narrative. We look at it when we're doing a deal. It's like saying we also, you have to have a clinical program. You have to have an evacuation program. It's just something that's not needed. You're already underwriting it as part of what we do, their risk management and how they carry out their risk management. And also, if you're in violation of your working capital and you're going to require operators to put cash into those entities, that's just something for tort litigators to grab onto. That's why all the cash is funneled up and out. Nobody wants to keep cash on their balance sheet.
Thank you.
Hi, Lauren Rexroth from Capital Funding as well. I just sort of wanted to follow up on a couple of Brian's points. I think everyone's sort of beaten a few of them to death, but I think this focus on owner-operator versus arm's-length operator sort of missing the point that Brian was getting to. A lot of these requirements are going to impact operators regardless of whether they're related to their landlord or not. And I think a few of the things to think through are whether these requirements reflect how any operator operates. For example, as Dom mentioned, just his cash management alone, but some of the other ways that operators work in a realistic format, we have a restriction that if you're not in positive working capital position, you can't make an advance to another project without HUD's prior written consent, which sort of defeats the purpose of a master lease and the cross guarantee of a master lease. So, and in reality, all day long, Dom is making intercompany due to, due froms that come out in the wash, on a monthly basis. And the argument would be any given day, he may, in one project, may not be technically at a positive working capital cash position, but has to make a payment to his, ancillary services company or something else. And so I think this will probably come out in industry comments, but these are some of the things to sort of think about how operators, regardless of whether they're arm's length or not, really do operate on any given basis, and whether having something that's that restrictive really, as Chuck and Steve and others have said, serves much of a purpose for us on an ongoing basis. One of the other comments that I wanted to make, putting my HUD lender cap on, I know some of you know me from the AR lender for financing, our concern from a HUD lender standpoint is some of the changes, in particular the switch of the priority in the intercreditor document, will force Amy and Pat and Jeff because they're bellwethers, they get daily reporting, will force them to ratchet down a whole AR portfolio's availability to the extent that because we have an issue on 1 out of 20 HUD buildings, they're going to take down your entire 20 HUD portfolio, 20 building HUD portfolio if they need to, because they're going to be forced to protect their assets so they don't get out over their skis at a point where there's a problem on one building. And that, to me, from the HUD lending standpoint, is really scary. I want them there. I want them, as we've talked about in states that are slow pay, I need them there to pay our rent if we're saying, or we need them to pay the payrolls. If we're saying that the debt service reserve, if we have one, is really only for us to use to pay the Ginnie Mae, keep it current, if we don't have that available to use to pay payrolls. It's just one of the considerations to sort of think about from a HUD lender standpoint of we need to give the AR lenders a little bit of flexibility to be able to keep their loan going while we need time to work our loan out.
I'm sorry, I just wanted to clarify, Lauren, on your comment. I think what you're saying is that if we make AR lending less restrictive with some of the provisions that were highlighted before, then AR lenders will tighten not just that particular loan, but their whole portfolio in order to alleviate any potential losses from the first?
Yes, because they're going to lose their priority position on, as sort of Pat and Amy have sort of talked about, what they consider their everyday normal lending collateral. When we have that cutoff time for our HUD loan, they're going to then, because they're allowed to, and it's an aggregate pool of collateral, whereas our loans, even though we have them on a master lease, are programmatically standalone, they're going to then pull and start to stress the rest of the projects in that HUD AR line, and they'll start to ratchet down availability to those, which then ratchet down Dom's availability to pay his rent on our otherwise perfectly performing projects.
Okay.
So.
Just a couple things real quick. On the working capital requirement, as you all look at that and comment on it, it'd be helpful if you look at the mechanism that we've laid out there. You're really not, I mean, the working capital calculation, or the working capital check, if you will, is when you submit those quarterly statements. And if you aren't in positive working capital, then you reconcile at that point. It's not a matter of HUD is, at any given hour on any given day, that if you have some fluctuation, that you're in regulatory agreement problem area. But so just as you put your comments together and come up with suggestions, just take a look at that, and we welcome your thoughts on that. And then Brian, you mentioned about the risk management. That language was really, that was brought over from what's being used on the master leases. In the master lease transactions, there's some risk management language there, and that was. It's true, we do risk management when underwriting and so on, but this really was aimed at, particularly with SNFs, the following up when a resident falls, injured, doesn't get medicine, all of that, the regulatory side of things from that aspect, and we've used that on. We've used that in master leases, but in master lease transactions, I should say, portfolio transactions. But we've also used it on many deals in loan committee. We will put that provision in, and this was, but that requirement is really speaking more to that aspect of risk management, and so we certainly welcome your comments on whether that ought to stay, go, or whether there ought to be some adjustment to the language.
Sorry, it's me again. To address your risk management. You said you've done it on master leases, you've done it in committee, you've done it on larger portfolio transactions, and to all those I agree. Okay, putting it in a rule, now it has to be done on one assisted living facility in Oregon, where they don't have an issue and they have a $1 million, $3 million professional liability insurance. They haven't had an issue ever. So now you're requiring them to put in place something, because it's a reg, that costs them money and doesn't provide any additional benefit that you can see. Credit committee, loan committee, perfect place to implement that rule. It's already almost a de facto requirement anytime you want a professional liability insurance waiver, which is any large portfolio. It also is there whenever you have somebody who has a lot of properties. Most people who have a lot of properties are already doing this. But the one-offs, there's just no need to make this apply. Regardless of whether it works on a 20-property nursing home portfolio, it's exactly perfect. On a one-person assisted living in Oregon, it doesn't really matter. They're already there. They already have full HUD-compliant insurance. So, yet again, the point of it being a reg instead of a practice takes away your ability to change it. And that I think, is one of the biggest factors. With regard to working capital, your working capital calculation, at least as I understand it, eliminates an awful lot of the receivables. It's only receivables up to 30 days. Okay, if you're in Illinois, you've just lost 150 days worth of receivables. So they will never be in regulatory compliance, or they will never be in a positive working capital position. So at a bare minimum, the calculation on the working capital as proposed is poor, because you have to count you can only count some of the receivables, yet if you have a borrowing on an AR line, you have to count that entire borrowing. So.
Thank you.
And as you're commenting about working capital in written comments, if your position might well be that we shouldn't have that requirement at all, but it would also be helpful, as we've said, to hear if HUD is going to have such a requirement, then it ought to do X, Y, and Z, or it ought to define it this way, and so on. So it would be helpful to hear those alternatives. And on the risk management language, one position might be that needs to go. That needs to be, as Steve's saying, be removed from the regulation. That language in the reg doesn't talk about whether you need third-party reports. It doesn't get into much specificity. Well, not as much specificity as, say, one might handle in the handbook. And so again, when you're talking about the risk management paragraph that we have in there, the provision, we'd welcome comments about variations on that in addition to just get rid of it or keep it. So, thanks.
Okay, a couple more comments. And
I just wanted to make a process comment. I know that the comments are due July 2nd. It's a painfully short period of time to comment on an awfully large volume of material when most of the people in this room are struggling to keep up with OHP's, or whatever you call yourselves now, excuse me, production. I have to say that the outcomes in the last several months in terms of the number of commitments it issued and the closing process has really been phenomenal. You need to be commended for that. But this is there's never a good time. This is a really bad time to make the comments. I also think it was suggested with respect to the AR issue that a group meeting or a series of discussions would be helpful, and I'd encourage you to think about that in a number of contexts. I realize you've got certain regulatory restrictions in what you can do now versus what you can do after July 2nd, and I think that maybe you can, I think you're maybe allowed to publish the stuff a second time and allow comments, although not be obligated to consider them. But John, to your point, it's very hard to submit comments in the alternative. Well, don't have it, but if you do have it, then do this, and if you don't do this, then do that. It just is very difficult. And sort of negotiating through the Federal Register is not really the way that people normally do business in the world. And so I would encourage you to look for opportunities, whether they're through Kaizen type events or other things, to identify what I think are the probably 3 or 4 main issues: the debt service reserve, the rider to the intercreditor and the intercreditor, and probably some of the restrictions on the operator, and allow for meetings to exchange views and work with drafting language. I think that'd be very helpful. And the last point, it was made a number of times, is HUD can pretty much force the lenders and the borrowers to do its bidding within some limited boundaries. But the third-party operators, the AR lenders, the depository banks, some of the third-party contractors, they're not going to go along with a lot of what we are talking about here today. And there needs to be a flexibility built into this process that does not exist in the multifamily process. Right now, as I understand it, it takes an act of Congress or Millie Potts to approve, an insertion of a comma in the documents, really. And that's probably fine for the multifamily documents in the situation we're dealing with, but there's going to have to be some sort of process that goes along with this that allows for flexibility, or else we'll just never get deals closed.
And one last comment from Rod Owens.
That's the way it always should be. I just wanted to echo Steve's point about all the improvements we've made over the years. I mean, I think I've been moved more than Kevin Bacon's speech in the Footloose from that. But and basically what Chuck is saying, I think it goes back to the first point I made, is having the handbook out will really help probably soften or change some of the levels of concern opposition, particularly with the Debt Service Reserve Fund. And I think, to Steve and Brian, a lot of the points about the reserve fund requirement is you have a strong borrower, it's going to discourage them from coming in for this, blanket requirement. And one of the things you may want to consider is having it where you can have a debt service reserve set up at closing for everybody, but you can change the funding requirements so that you spread it out over a number of years, or you can delay funding until a borrower gets to or project hits certain financial thresholds, so that you have a strong borrower, they're performing, there's no need for the reserve fund, then you don't have it, and you can encourage them to come in. But if their operations deteriorate, maybe they're not going to object so much to saying, okay, then we'll slow down our distributions to our principals and build up a debt service reserve fund. So you've got today encouragement to come into a good program, but then the protection that you guys are looking for 15, 20 years from now. So so there is a balance, but it's hard to do that in this context of Chuck said negotiating through the Federal Register with just loan documents and just some regulations and not the handbook. So I think you have to look at the legal process for doing this, but I think it'd be very helpful to have that handbook and some of these guidelines, and that will change the way that I think the lending community reacts. But we do appreciate all your efforts in this and improving the program, and as Steve said, the changes over the last several years has been tremendous for the industry.
One last comment? James?
I'm Jim Levine from Baker Donaldson. One thing I would encourage you to do is when you think of the effective date when the new regulations go into effect, is make that a date after which a certain application is filed with HUD, not after a commitment is issued. Because if the issues go into effect for projects that have already filed applications relying on the old rules, that might cause some consternation for people who relied on the old rules. So I would just encourage you to make the effective date a date based on the application date rather than a firm commitment date going forward.
Thank you. All right, well, thank you for everybody. I think this was an extremely valuable session, especially the panel, and we appreciate all of those insights. Roger Miller now would like to make some closing remarks.
First of all, I want to thank you all.